one way to lose your margin of safety is to get greedy. It's like you can still drown in a pond that on average is 1 foot deep because you might step off the wrong point. And the leverage gets you just at the wrong moment, just when the market is terrible, when something unexpected has happened in the world. And if you're forced to sell things that are down a lot at a terrible time, at a minimum, you might go broke, but even if you don't, you're giving up great opportunities at bargain prices. The key in investing, I think, is to always be in a position when things are really attractive in the market that you have an ability to buy into that and take advantage of even more egregious mispricings than might be there most of the time.
What if I told you it was possible to turn $100 into $1.8 billion by applying a simple set of timeless investing rules? That's exactly what legendary investor Seth Klarman did. He made his first $100 investment at 10 years old. Today, he has a net worth of almost $2 billion. But here's the catch. The strategies he used go against almost everything you see on Wall Street. In this rare interview, Klarman reveals how you can build serious wealth by thinking differently, buying intelligently, and avoiding investment traps. By the end of this video, you'll understand exactly how to spot real bargains and position yourself to profit, even during downturns. Stick around until the end of the video to hear what Klarman has to say about avoiding catastrophic losses, as it might just save you from going broke in the next market crash. Let's dive in.
Value investing has two main advantages over other forms of investing. One benefit will be that you're buying something at an immediate bargain. You may make more money than just recovering from the bargain to full price because the company over time might grow. And that raises I think the really legitimate question of how you know something's at a discount. And of course, how do you know what something's worth? A lot of people bandy about the phrase intrinsic value, as though a company has an exact value that you can ascertain. And I don't actually believe that's possible. I believe in the concept of a range of values. When you think about a business, it has value so many different ways. It has value as a stock, but it has a different value, or sometimes a different value to an acquirer. It might have a different value if their capital structure were mostly debt or mostly equity. And so I think that it makes sense to use multiple metrics to kind of triangulate into value. So you have to be versatile in your thinking.
Now, this is one of the most important lessons in all of investing. Klarman's telling us that intrinsic value isn't just a single number. It's actually more of a range. The real value of a company depends a lot on context. Who's buying it, how they plan to use it, and even how the business itself is structured. Let's break that down with a real-world example. Back in early 2009, Marvel Entertainment's market value was sitting just under $2 billion. But fast forward 10 months later, and Disney bought Marvel for over $4 billion, more than double what investors thought it was worth. To the average investor back then, Marvel was a modestly successful comic book company. They licensed their characters for movies and merchandise, but it wasn't anything spectacular. To Disney, however, Marvel wasn't just comics and movies. It was the missing piece in a much bigger puzzle. Marvel brought something Disney valued immensely: intellectual property. With more than 5,000 unique characters and decades of stories, Marvel was a treasure trove of content ready for movies, TV shows, toys, and theme parks. It also gave Disney a way to reach young boys and teenage fans, a market they hadn't cracked with their princess-led stories. An investor looking at Marvel in 2009 might have thought even $2 billion was expensive based purely on its existing profits. But Disney saw a completely different kind of value. They saw potential. To them, even $4 billion was actually cheap. And Disney was right. By 2019, just 10 years after buying Marvel, Marvel Films had earned more than $18 billion worldwide, quadrupling what Disney paid. In 2021, Forbes estimated Marvel's value at $50 billion, 25 times its market cap back in 2009. This is exactly what Seth Klarman means when he says intrinsic value isn't a single number. It really depends on who's looking at the company and what they plan to do with it. And because value isn't fixed, Klarman advises investors to use multiple methods to figure out what a company is really worth. When I'm analyzing a stock, whether it's for my job on Wall Street or for our research newsletter for our premium subscribers, I rely on multiple approaches. Typically, I'll run a discounted cash flow analysis. I'll review what comparable businesses are trading at. I'll build an earnings growth model, and I'll look at the value of companies' assets. But there's another pretty simple way to create a range of potential intrinsic values for a stock. It's called scenario analysis. Instead of predicting one single future outcome, you lay out a few different possibilities, like a base case, a worst case scenario, and a best case scenario. Then you estimate the company's value under each scenario using your preferred valuation methods. By doing this, you get a realistic range of values rather than just guessing at a single number. And that's exactly Klarman's point. Successful investing isn't about finding the one perfect valuation. It's about understanding the possible range of values and knowing roughly where the company fits within that range. But even once you've figured out that something is undervalued, Klarman believes there's still one more crucial question you have to answer.
You can use comparables. You can say other stocks like this company trade at 15 times earnings, which causes you to say, well, is this one a bargain at 11 times? I would always then go further. I don't just want to know that something is cheap, that something is a bargain, but I want to know why. That's part of the analytical process, is to dig, not just to say, can I trust those cash flows? What about the business makes that particularly safe or particularly risky? But you can also say, well, I think that stock is mispriced from something that went wrong a few years ago, or the management doesn't have the best reputation because of the following, and that lends itself to analysis. So you have a lot of ways of coming at value, and that helps you kind of calibrate, am I sure I'm getting a bargain?
This point from Klarman is crucial for any investor to understand. He's saying that just because a stock looks cheap doesn't mean it's actually a bargain. A common shortcut people use is the price-to-earnings ratio. It looks at how much you're paying for each dollar of a company's profits by dividing the share price by earnings per share. If it's lower than peers, you might think you're getting a great deal. But Klarman warns us, that's just the starting point. Think of it like buying a used car. Two identical models, same year, but one is cheaper. Seems like a deal until you find out it's been in an accident and has engine troubles. That lower price isn't a bargain. It's there for a reason. Stocks are the same way. If a company is trading at 11 times earnings while others are at 15, it might look like a steal. But you have to dig deeper. Maybe it's losing market share, facing tough competition, or led by a management team the market doesn't trust. Klarman warns us to go beyond the numbers. Look at the business's track record, the management, and what's really behind those earnings. That means reading old earnings calls, checking out leadership, and understanding the industry. Here's the key takeaway. A low PE ratio isn't an automatic green light to buy. It's just a clue. It's up to you to figure out if that clue is pointing to hidden value or hidden problems. Klarman's next point is all about how to protect yourself, even if you've done this analysis right. Let's jump into that.
Another really important facet of value investing is having a margin of safety. I think we all understand in some way that when you have a certain amount of money, doubling that amount of money may not make all that much difference to your lifestyle, but losing all that money would make a devastating difference. The idea of a margin of safety is that you have comfort because by buying at a discount, things can go wrong. You can have bad luck, you can have imprecision, you can have just the vicissitudes of the business cycle, and those things can go against you, and you still may not lose anything. And if you buy it at a big enough discount, the margin of safety means things won't go terribly wrong because you've already baked some room for things going wrong into your price. I think Warren Buffett likes to say that when you build a bridge, you build it so it can drive 30,000-pound trucks across it, but you don't actually drive those trucks, you drive 10,000-pound trucks. And so that's a similar margin of safety. And I think that approach works obviously in investing, but it actually is a sensible approach for other things in our lives. So I think the idea of a margin of safety protects you, and in a way, it also fuels future gains, because by not losing an unimaginable amount in a bad period, you're actually able to play offense in that bad period when other people maybe are having to sell or unable to buy.
Smart investors know it's not just about chasing returns. It's about protecting yourself first. Margin of safety means buying at a price that's well below what you think something is worth. If you believe a business is worth $100 per share and you buy it at $70, you've built in a $30 cushion. That cushion protects you if things don't go exactly as planned. Think of it like buying a house worth $500,000 but getting it for $350,000. Even if the market drops or you find hidden repairs, you've given yourself a buffer. That's what margin of safety is all about. Klarman's telling us, if you invest with this mindset, you won't just survive the market's rough patches, you'll come out stronger. And Klarman doesn't just apply this to picking stocks. He applies it to how he invests, how he manages risk, and how he controls his behavior. In this next clip, he explains how the way you build your portfolio can be just as important as the price you pay.
One of the ways you get a margin of safety is not just investment by investment, but it's also how you behave, how you run the whole portfolio. So I set guardrails for myself and my firm. One guardrail that we have is portfolio diversification, that you might have an exceptionally attractive investment, but humans can be wrong, and you always have to have the knowledge you could be wrong. So we're always balancing the pull to own more of great ideas with the risk of owning too concentrated a portfolio. And not only is concentration name by name, but it's sector by sector. If bottom up, you find that financials are extremely compelling, you probably still don't want a third or half of your money in bank stocks because they're too concentrated. When things happen in the sector, they all tend to move somewhat in tandem, and that would be a source of introducing risk into the portfolio.
Klarman's shifting the conversation here, from picking individual stocks to how you structure your entire portfolio. His key message is simple. Even if you found a great idea, you still have to assume you might be wrong. That's why diversification matters. It's not about hedging your bets. It's about managing your risks and accepting that even the best investors get things wrong sometimes. Good diversification stops one mistake from taking down your whole portfolio. Think of it like a house. You wouldn't build it without fireproof walls between the rooms. If a fire starts in one room, those walls stop it from burning everything down. Diversification works the same way, protecting your portfolio when things go wrong. But Klarman takes it even further. He warns that it's not just about avoiding over-investing in one stock. It's about not being too exposed to one sector, because even if you own 4 different companies, they might still share the same hidden risk. Let's look at a real-world example, the market crash in 2020. Say you had Delta Airlines, Marriott Hotels, Carnival Cruises, and Booking.com. On paper, that seems like a diversified group. An airline, a hotel, a cruise line, and an online travel service. But in March 2020, when global travel stopped, they all crashed together. Delta dropped 60%, Marriott fell by half, Carnival lost 75%, and Booking sank 45%. On average, your portfolio would have been down nearly 58%. For comparison, the S&P 500 fell about 34%. So even though you held different stocks, they were really just one big bet on travel. And when travel stopped, everything sank together. On Wall Street, this is known as sector correlation risk. That's exactly what Klarman is warning us about. Diversification isn't about owning a lot of stocks. It's about owning things that won't all fail at the same time. Next, Klarman digs into another way investors can accidentally destroy their margin of safety.
Another guardrail is not using recourse leverage on the portfolio. That is whether an investor would ever use borrowed money. That an investor that takes out margin loans that in effect are leveraging the portfolio, that investor will have the benefit of leverage. You'll make more if you're right, because that's what leverage does. But leverage also magnifies the downside if you're wrong. And so one way to lose your margin of safety is to get greedy. It's like you can still drown in a pond that on average is 1 foot deep because you might step off the wrong point. And the leverage gets you just at the wrong moment, just when the market is terrible, when something unexpected has happened in the world. And if you're forced to sell things that are down a lot at a terrible time, at a minimum, you might go broke. But even if you don't, you're giving up great opportunities at bargain prices. The key in investing, I think, is to always be in a position when things are really attractive in the market that you have an ability to buy into that and take advantage of even more egregious mispricings than might be there most of the time.
Klarman's giving us a clear warning here about one of the quickest ways to lose your margin of safety, using leverage or borrowing money to invest. On the surface, leverage sounds smart. When markets go up, it boosts your returns. But it has a dangerous flip side. Here's how leverage really works. You're not just investing your own money. You're investing with money you owe. So when the market's rising, leverage amplifies your gains. But when it falls, it magnifies your losses too. Think of it like placing a bet with borrowed money. If you win, everyone's happy. But if you lose, you still owe your friend. That's exactly what happens with leverage. And if the market drops enough, your broker, or the one who lent you the money, will not wait around. They'll issue a margin call, demanding you put in more cash. And if you can't, they'll start selling your stocks immediately, whether you want to or not. This forced selling usually happens at the worst time, during a market crash, locking in losses instead of letting you hold on or even buy more. You might have been right about a company's long-term future, but with leverage, one big drop can wipe out your position completely. That's why leverage is so dangerous. It can make the good times feel better, but it turns the bad times into disasters. Klarman's lesson is simple. Structure your portfolio so that when everyone else is panicking and selling at huge discounts, you're the one who's calm, prepared, and ready to buy. This discipline and preparation is exactly how great investors like Klarman make money. And if you want help building that same kind of discipline into your investing, without spending hours buried in earnings calls and annual reports, we've built something for you. It's called Investor Center Research, a monthly stock research service for long-term investors who want clarity, confidence, and a shot at real financial freedom. Each month, we break down one high-quality, mispriced company, the kind of business we'd want to own for the next decade, and show you exactly how we're thinking about it. You'll also get access to our model portfolio to see what we're buying, what we're holding, and why. Here's the best part. We've got 250 founding member spots up for grabs when we launch in a couple of weeks. Founding members will lock in our lowest price ever for life. If you want first dibs on one of those spots, join the waitlist now. You'll get a 6-hour head start before we open to the public. Plus, if you join today, we'll send you a free copy of our guide, Charlie Munger's 11 Mental Models to Beat the Market. These are the same shortcuts Munger used to spot winning businesses and avoid costly mistakes. And now, they're yours. Just click the link in the description to get the guide and join the waitlist. Thanks for watching, and I'll see you in the next one.